back to the Trading Desk. When we wrapped up the last episode, Matt made a really good point about knowing when to, buy them, hold them, or fold them, to quote Kenny Rogers. But I think what's really important for investors going forward in 2010 and always is, when do you get rid of a trade? I talk to a lot of potential clients up at the Athletic Club and stuff. They watch the show, and the one theme I always see is that they never know when to let go. They're always thinking, we're going to the moon on this baby, and I think they get devoid of reality.
Yeah. Well, it's interesting that you say that, because in the interview coming up with Greg Zuckerman, the senior Wall Street Journal reporter who wrote The Greatest Trade about John Paulson, one of the things that he talks about with Paulson is that he has conviction, but he's not willing to challenge his own conviction. And I think that's something you and I talk about often. And as a trader, I think you come from a spot where you're always challenging yourself. You have to go out and ask not only the markets but other players. What do you think? What are you seeing out there?
Exactly.
And try to get a feel for that.
Well, it goes back to that whole idea of you just don't buy it and hold it and stick it in a drawer.
Right.
You got to take the temperature every once in a while. Does this company still make sense? Are they still does the economy make sense?
Right.
I'm reading an interview right now about some of the best global macro traders. And all they're trying to do every day is identify, where's the next opportunity? Is it going to be in treasury bonds? Is it going to be in gold? And they're just always asking questions.
Right.
They never sit idle.
And they're trying to find that change, if you will, that change of direction.
Yes.
Because that change of direction, whether it's a 5-minute chart or a 5-year chart, is the most powerful spot where you make your money. So, and to your point, Dave, what you're talking about is, hey, maybe in this situation where we were talking about 10-year and the S&P, that there was a big change in direction there, but that easy money has been made. And what happens in markets, I think, is you go through these periods where you have to catch that move, and then when it happens, and it's had a big one, especially in the S&P, 70%, time to take some profits probably, and maybe leave a little bit for the backside, because that little bit can make all the difference in your portfolio. You don't need to have the whole thing. You don't have to be in love with it.
Exactly.
As we talk about.
Well, I think the timing of this but this rationale is key. We just started the new year. I started getting emails from clients last week saying, where are we going? What are we going to be doing? Everybody's anxious. I mean, I'm anxious.
Yeah.
I got up this morning, I wanted to put some trades on, but I'm looking at the markets going, there's no
Just
clues.
because the calendar has changed,
Exactly.
January 1 doesn't necessarily mean there's a trade. And I find it's the same kind of cycle happens on a Monday or a Friday.
Yeah.
Hey, Monday, we've been closed for 2 days, and so those animal spirits come back.
Yes, exactly.
And people, as you said, want to get into the action, but that doesn't necessarily make it it does depend, but it doesn't necessarily mean you need to do something.
Right, and I think based on the points you just made, S&Ps have rallied 60, 70%. Treasury bonds yields are heading into 4%. There's no obvious trade, at least to me right now.
Very, very muddled.
And I think if you and I are a little bit indecisive or not clear, I think the average investor's got to say, you know what, I got to take a step back.
Yeah. So again, we come to that theme of patience and diligence. I mean, with a position or a trade, it's sometimes the hardest thing I think to do as an investor or a trader is to wait. And be patient.
Very hard. For most people, it is. Most people are wired to always want to be in the action.
Well, and I think part of it also is the industry always telling you've got to be fully invested.
It's true. It's very true.
And you and I don't necessarily agree with that. So
no, you and I both would agree there is no correlation between trade frequency and profitability. In fact, it's probably an inverse relationship as far as I'm concerned.
Well, and as I always say, trade less, make more. I mean, these are colloquialisms and definitely cliches, but they're true because. Sometimes, again, catching those moves is all you need. You catch that move, that breakdown that we just saw in the bonds, and you can make 2 years worth of money in a short 1 month time.
And you'll tend to have more conviction with fewer ideas because it's well thought out. And when things don't go well, but you have your conviction, you're likely to stick with the trade,
right?
Even if you end up being wrong.
Right. Well, we're going to take a break. When we come back, I've got an interview with Greg Zuckerman, again, senior reporter with Wall Street Journal. He did a fantastic book called The Greatest Trade about John Paulson and the John Paulson Fund. You're watching The Trading Desk.